Welcome to the Deep Dive. We sift through sources to pull out the key insights for you. Today, we're digging into an investor's guide to becoming a private capital partner. Think private real estate finance, our mission. To really break down this guide, give you the core ideas. We'll cover what a private capital partner is, why you might consider it, how it works, the opportunities, the risks too, and how funds are protected. The guide's big idea is that real estate is great for long-term wealth, focusing on, quote, win-win solutions. Okay, let's start there. For our listeners, what exactly is a private capital partner in real estate? What makes them different?
Right. So private capital partner, or PCP, is basically an individual. They fund real estate deals directly with borrowers. And the key thing is they operate outside the traditional banks. They're using their own capital. Often for deals, banks, well, they tend to avoid.
Avoid? Like what kind of deals?
Think short-term projects, maybe distressed properties, or deals needing really quick closes, like days or weeks. Banks are just generally too slow or rigid for those kinds of things. That's where PCPs step in.
Okay, that makes sense. Fills a specific gap. So for you listening, what's the draw? Why become a PCP? What are the big advantages the guide highlights?
Well, the guide points to a few key things. First off, portfolio diversification. Moving beyond just stocks and bonds. Real estate adds a different element, can hedge against other market movements.
Right, something tangible.
Exactly. Then there are the higher returns. This is a big one. The guide mentions historically delivering double-digit returns.
Double digits. How does that compare?
Well, the guide contrasts it with the S&P 500, maybe 7-8% annually over the last 30 years, on average. Bonds, CDs, maybe 2-4%. Partnering directly lets you negotiate potentially more favorable terms than you'd get through, say, public markets or banks.
Okay, so potentially higher returns. What else?
Then there's passive income. You're receiving regular payments from borrowers. It's truly passive, not like managing a rental yourself.
Less hassle.
Much less. You also get exposure to real estate itself, potential appreciation, and it's all backed by a real asset as collateral. And don't forget professional networking. You build connections with other investors, real estate pros, borrowers. That opens doors.
Those returns sound appealing, definitely. But is there like a catch, maybe a higher barrier or a different kind of risk we should know about?
That's a fair question. The higher returns often reflect the illiquidity, maybe, and the specific nature of these deals. They're not like buying a stock. The risk profile is different. You really need to assess the borrower, the property, which is why the process itself is so important.
Okay, let's get into that. The how. How does this lending process actually work step by step according to the guide?
It's essentially a 4-stage process. Pretty logical. Stage 1, analyze the property. This is crucial. Underwriters dig deep.
Underwriter, so financial analysts.
Exactly. They look at market value, property condition, rehab costs, potential returns, the whole picture. Assessing the risk and profit.
Okay, thorough vetting. Then what?
Then, stage 2, fund the deal. If everything looks good, the borrower signs the loan docs. Terms are set with a title company or attorney, and then your funds go to escrow.
Escrow, okay, safe place.
Right. Stage 3, purchase property. The borrower closes on the property, then they start the rehab work to improve it for resale or rent.
And the final step, getting paid back.
That's stage 4, sell property or refinance it. Your principal plus your agreed upon fee gets repaid from those proceeds. The borrower keeps the rest. The guide calls it a repeat process because successful partners often do this again and again.
Okay, so the borrower fixes it up, sells or refis, and you get your investment plus the feedback. Sounds straightforward. But what's the typical wait time for that return? And what if things take longer than expected?
Good question. The timeline really varies depending on the type of deal. We can talk about those specifics. But generally, it's often shorter than, say, a long-term buy and hold. If things get delayed, well, that's where the loan documents, the promissory note, et cetera, kick in. They outline penalties and protections.
Perfect transition. Let's talk about those deal types. What specific lending opportunities does the guide mention? And what about those timelines and returns?
Yeah, the guide details 4 main types. First is the classic fix and flip. Your funds cover renovations, property gets sold for profit, usually wraps up in, say, 3 to 9 months. Typical return range mentioned is 12-24%.
Okay, fix and flip, pretty common. What else?
Second, an earnest money deposit. This is interesting. Your funds act as the buyer's good faith deposit.
Yeah.
Shows they're serious. These are super quick, 30-60 days. And the return, typically higher, 36-60%, because you're providing crucial short-term liquidity.
Wow, that's fast. And a high return for that short period.
It reflects the need for speed. Then there's proof of funds. Here, your money doesn't usually buy the property directly. It often sits in escrows just to show the buyer can close, maybe while they line up permanent financing. That's typically 3-4 months, with returns maybe 15-40%.
So proving financial capability. Interesting. And the last one?
The fastest. Double close. Your funds buy a property and it's immediately resold to another investor, like back-to-back closings. This can happen in just 1-2 days. The potential return range mentioned, 36-90%.
1 to 2 days, up to 90%. That sounds intense.
It is. Very fast-paced. And of course, the guide adds that important disclaimer. Past results do not guarantee future returns. Always key to remember.
Absolutely. That double close, though, up to 90% in a couple of days. What makes that possible? Is that something a beginner should even consider, or is it more for seasoned pros?
You hit on it. The speed and return reflect the immense value of immediate cash in certain situations. Maybe a borrower found an amazing deal but needs funds, like now.
Tomorrow.
Exactly. Banks can't do that, so you command a premium. But yeah, it usually requires a sharp eye. You need to assess the deal and the borrower very quickly. Probably better suited for more experienced investors, generally speaking.
Makes sense. Okay, we've heard the upside. Now, the reality check. Risks. Every investment has them. What does the guide identify as the main risks for a private capital partner?
All right, need to be clear-eyed about this. The guide highlights three main categories. First, default risk. Pretty simple. The borrower might not be able to repay. Could be financial issues, project problems, market changes. Yeah. Things happen.
Okay, borrower default. What else?
Second, collateral or market risk. Your investment is secured by the property, right? So if the property value drops significantly, maybe a market downturn of the column, the collateral itself is worth less. That increases the risk that if you had to force a sale, it might not cover the full loan amount.
Property values fluctuating. Got it. And third?
Regulatory and legal risk. Lending laws can be complex. They vary. So there's always a risk of noncompliance, potential legal issues, maybe even loss of funds if things aren't structured correctly according to regulations.
Okay, default, market shifts, legal stuff. That definitely leads to the big question. How are your funds protected? What safeguards does the guide mention?
Protection is absolutely key. The guide lists several layers. First, the promissory note. This is your core legal document. It spells out everything. The collateral, the amount borrowed, the fee you get, repayment terms, what happens in default. All of it.
The contract, basically.
Precisely. Second, a lien on the property, usually a deed of trust. This gives you a legal claim on the property itself. It gets recorded publicly, so everyone knows your interest is secured.
Okay, a legal claim on the actual real estate.
Yes, and then there's often a personal guarantee. The borrower personally promises to repay the debt, not just the business entity. It adds another layer beyond the property.
So they're personally on the hook.
Right. The guide also mentions things like joint venture agreements, operating agreements, insurance certificates, more paperwork, more layers of protection. The guide is very clear. Protecting investors' capital is always top priority, and investments are 100% collateralized by real property with multiple protections.
Okay, multiple protections sound good. Promissory note, lien, personal guarantee. But are these always standard? Or could a newer investor end up in a deal missing some pieces? And I mean, even with them enforcing these things, if there is a default, that takes time and money, right? That impacts your real return.
That's a really important practical point. Yes, the guide presents these as what should be there in a well-structured deal with a reputable partner. But the reality is, private lending can vary. You need to ensure these are in place. And you're absolutely right about enforcement. Having the lien is one thing. For closing on it takes time, involves legal fees. It eats into returns. It's why the upfront due diligence on the borrower and the deal itself is so vital. Better to avoid the default in the first place.
Absolutely. Prevention is better than cure there. Okay, so let's tie this all together for our listener. What are the main takeaways from this deep dive into private capital partnering?
I think the core appeal boils down to a few things from the guide. The potential for genuine passive income. Those attractive potential annual returns. 12% up to maybe 90% depending on the deal type, and the security blanket of having real estate as collateral. It's about wealth building tied to tangible assets. Offers a different kind of foundation in a portfolio.
And the guide mentioned a minimum investment, $50 K, I think, to start your passive income journey. That's a significant chunk of change. Does the guide say why that amount or what someone needs before committing that?
Yeah, the $50,000 figure likely reflects typical deal sizes in this space and the operational costs of setting these things up. It suggests it's aimed more at perhaps accredited or sophisticated investors or those looking to diversify an already decent-sized portfolio. It's not really an entry point for someone just starting out investing small amounts.
Right.
It highlights that while the returns look great, it requires a certain level of capital commitment, which circles back to the most crucial advice repeated in the guide. Always do your own due diligence before investing, no matter the potential return.
Solid advice for any investment. Well, that wraps up this deep dive into private capital partnering. Thanks for tuning in.